Unraveling Quantitative Easing, a simple guide. Hello, everyone. Welcome back to our channel, where we make learning English easy and fun. Today, we're diving into an interesting topic that often pops up in news related to economics and finance: quantitative easing. If you've ever wondered what this term means and why it's important, you're in the right place. Let's break it down together, ensuring that you can not only understand it but also use it confidently in your conversations. So, let's get started. Quantitative easing, QE, is a monetary policy used by central banks to stimulate the economy when traditional monetary policy tools become ineffective. In simple terms, it's like the central bank's version of putting fuel into the economy's engine when the regular fuel pump isn't working. The central bank does this by purchasing government securities or other financial assets from the market, which increases the money supply and encourages lending and investment. Think of it as the central bank creating digital money to buy these assets. This process aims to lower interest rates and increase spending and investment to boost economic growth. To understand how QE works, it's important to know that by buying these assets, the central bank injects money directly into the financial system. This increases the money supply, which can lead to lower interest rates. Lower interest rates make borrowing cheaper for businesses and individuals, which encourages them to spend and invest more. This increased spending can help stimulate economic growth, especially during periods of low inflation and high unemployment. However, it's also worth noting that QE can have various effects, such as raising asset prices and affecting currency values. The primary goal of quantitative easing is to avoid deflation and stimulate economic growth during tough times. Deflation, a general decline in prices, can be harmful because it may lead to decreased consumer spending and investment. By using QE, central banks aim to increase inflation to a healthy level, encourage spending, and keep the economy moving. Additionally, QE can help improve liquidity in the financial markets, ensuring that banks and other financial institutions have enough funds to operate smoothly. Quantitative easing has been used by several major central banks around the world, including the Federal Reserve in the United States, the European Central Bank, and the Bank of Japan. Each of these institutions has applied QE in different ways and scales, depending on their specific economic conditions and challenges. The effectiveness and consequences of QE can vary, leading to much debate among economists and policymakers about its long-term impacts. And there you have it, a closer look at quantitative easing and its role in the world of economics and finance. It's a complex tool that central banks use to try and keep the economy stable and growing, especially during challenging times. We hope this video has shed some light on what QE is and why it matters. Don't forget to practice using this term in your English conversations to help solidify your understanding. Thanks for watching, and we look forward to exploring more fascinating topics with you. Stay curious, and see you in the next video.